I believe you're looking for 25 basis points if we can get right to this. If that's the case, is it because the Fed doesn't want to spook the market, to think that things might be worse than initially believed, or to not be perceived as political?
I don't think it's a political element. The Fed is independent. It's going to pursue monetary policy independent of what's happening in Washington and certainly with the elections. In terms of going 25 versus 50, I do agree that 25 would be about right. I think certainly when we look at the labor markets in better balance, inflation is heading back to the 2% target over time. And also the labor market is doing relatively well, even though it's certainly not as strong as it was post-pandemic. Yeah. But I think that anything more than 25 basis points would spook markets and indicate that the Fed is more worried about the economy.
Okay.
Well, so if you don't necessarily see reason for that material worry at this point when you're looking at the labor market, knowing that the tight policy we already are living with is still, the lag effects may still be kicking in, and we're just starting to see it really affecting the labor market. If they decide not to go big up front, knowing their next decision isn't until November, could it be too late then for a larger cut to actually avert something bad happening in the labor market if we see a serious disintegration between September and October?
Well, back to the labor market, I think that it's slowing because you don't need to run the faucet as hard to fill up the tub. I think we're at full employment, and so you don't need outsized gains in payrolls. But certainly if the Fed does sense that there's something worse with the economy, that consumer spending is going to slow dramatically, and or, yes, we do see material weakening in the labor market, then the Fed has plenty of room to go ahead and amp up the size of its cuts per meeting.
With all of that said, we've been asking a lot of economists about where the economy will be when the next president takes office, whether it's Donald Trump or Kamala Harris, considering the fact that we are entering a new regime now. What will this look like, feel like in January?
Well, our view is that the second half of this year will see slower GDP growth. Yes, as we're seeing ongoing effects and probably the full effects of tight monetary policy on business investment and consumer spending. And let's not forget, consumers are also levering up and need to repair their balance sheets. But we think that starting early next year, the economy will pick up. We'll see stronger growth as the Fed cuts interest rates. Businesses will get back out there and invest. Consumers who are looking to buy a home will see lower mortgage rates. So we think that we will continue to see some improvement in the first half of next year, and then very strong improvement in the economy in the latter half of next year.
Well, of course, the economy could also be impacted by the policies the next president will pursue when they take office in 2025. And Kamala Harris gave a little taste of further policies she would like to see when she spoke earlier today at the National Association of Black Journalists, talking about a cap on child care costs. This is what she said.
My plan is that no family, no working family should pay more than 7% of their income in child care. Because I know that when you talk about the return on that investment, allowing people to work, allowing people to pursue their dreams in terms of how they want to work, where they want to work, benefits us all. It strengthens the entire economy.
So, Dana, obviously there is a question as to how this policy would actually be implemented, if it could even get through Congress. But when she speaks about the economic effects it could have, what would that do to female labor force participation, for example?
Certainly, female labor force participation in the United States is very low compared to other economies, even Canada, our northern neighbor. And certainly, we're looking at labor shortages across a number of industries. So one way to address labor shortages is to have more people. And certainly for women, having that option to put their children in childcare, or also to address adult care for persons who have older adults that they're caring for, such that they can go to work. So certainly this would help with labor shortages as well as bolster household incomes and potentially also consumption.
Dana, what happens to payrolls growth in this country if you take away taxes on overtime?
Well, I think it certainly could help bolster payrolls when you have certainly, again, labor shortages, especially in places where you have to physically show up to work, like restaurants, where you're most likely to receive overtime or even tips. So you could see some improvement in labor market activity, but I think it's more going to be on the income side, where people will see boosts in their income and consequently have more space to consume.
Obviously, we're getting a little bit ahead of ourselves and looking at the potential policy of the next president, who still has an election to win in November. I know we talked about what kind of economy they will inherit in January, but there's also the question of how people will be feeling about the economy when they go to cast their ballot. We've been talking a lot about vibes, Dana, and consumer sentiment from the Conference Board or even University of Michigan is kind of a vibe check in some way. How do the vibes feel to you right now?
Well, it's interesting. Consumers are saying they're a little bit more concerned about the equity market, certainly after the episode we had in August. They're also more concerned about the labor market and job prospects going forward, and they're still complaining about prices being elevated. Nonetheless, they continue to spend. When we look at the data, certainly for retail sales and PCE in July, consumers spent about 3% annualized in real consumption in July. And then for August, yes, retail sales were kind of weak. They were down a tick in real terms. But still, when you fold up July and August, retail sales still grew by 3.3% annualized. That doesn't sound like an economy, or at least a consumer, that's really concerned. And indeed, when we ask consumers point blank, do you believe a recession is coming? Most are saying, no, we don't. So I think it's really going to be about how much consumers want to repair their balance sheets after accumulating debt, and if they remain employed. And again, we think that most consumers will hold on to their jobs because companies are not letting them go, and that's going to support consumption going forward.